Hey, Stock Talk listeners, welcome back to the deep dive.
Great to be here.
If you're trying to make sense of the investment world, especially, these high growth, high risk areas like electric vehicles, getting clear info is key.
Absolutely. It's noisy out there.
And that's what we do here. Today, we're diving deep into one specific company that gets a lot of attention, a lot of debate, NIO Inc. Ticker NIO on the NYSE.
Yep, we're going to unpack a pretty detailed investment analysis on them.
So if you find this kind of breakdown useful where we sift through the reports for you, please do us a quick favor right now.
Yeah, hit that subscribe button for the deep dive. Seriously, it helps us out, and make sure you catch our future deep dives. Be precise, just click subscribe.
Do it now. Okay, let's jump in. The source material for today's discussion is from stocktelescope.com.
They put out a really in-depth piece on NIO recently.
Yeah.
And it paints a fascinating picture, but definitely a high-stakes one.
Before we get into any of the analysis, though, we have to share their disclaimer. This is crucial, and we're reading it exactly as they wrote it. Okay, here it is. This analysis is for informational purposes only and does not constitute investment advice. NIO is a highly speculative investment with significant risk of total loss.
Right, and it continues. The Chinese EV market is experiencing unprecedented competitive pressure that could result in company failure. Investors should conduct their own due diligence and consider their risk tolerance carefully.
And the final part, the author has no position in NIO securities as of the publication date.
Okay, so that disclaimer really sets the stage, doesn't it? It's not just legal text.
Not at all. The report itself immediately flags NIO as a high-risk speculative investment. That's their core label, right up front.
So our goal today is to understand why. Why that label? We need to explore the opportunities the analysis sees, sure, but really put a spotlight on those huge risks they highlight. This is definitely aimed at, well, sophisticated investors considering NIO.
Exactly. The report doesn't sugarcoat the environment. It talks about this extremely competitive Chinese EV market, a brutal price war, NIO's own heavy cash burn, and even negative shareholder equity. It's a tough setup.
Wow. Okay, so given that challenging picture, what's the actual investment thesis from Stock Telescope? Why even consider it?
Well, their core idea is that it's a play on asymmetric risk-reward. Essentially, it's a high-risk, high-reward bet.
A bet on what exactly?
On NIO's innovative tech. We'll get into that, and its potential to, somehow navigate these market challenges or maybe benefit if the market eventually recovers.
So the idea is if it works out, the upside could be big.
Potentially much bigger than the downside from the current price. But, and this is key, they keep hammering home that significant risk of total loss. That's definitely still a real possibility.
Okay, asymmetric risk reward for investors who can tolerate that kind of risk. You mentioned the current price. Where is it trading, according to the report?
The analysis pegs it around $3.52, which is pretty close to its 52-week low of $3.02. and way down from the high of $7.71.
So when they say it's priced for distress, that means the market's already expecting bad things.
Pretty much, yeah. The stock price already reflects a whole lot of negativity and pessimism. So the thinking is, because it's so low, if anything goes right for them, strong execution, market improvement, the percentage gain could be substantial.
But the flip side is?
The flip side is, because the company's finances are shaky, the risk isn't just the stock dipping a bit more, it's potentially going to zero. Total loss.
So the analysis is saying, for someone who gets that binary outcome, big win or total loss, and can stomach it, the current price offers a compelling speculative entry point.
Relative to the potential upside, yes. That's the argument. It's about the ratio of potential reward to potential loss from here, while fully acknowledging that zero is a possible outcome.
Understood. So based on that, what's the actual speculative price target range the report gives, say over the next 12 to 24 months?
For that risk-tolerant investor, they set a speculative buy-Y target range. It's between $5.50 and $7.
Okay. Let's dig into the financials presented in the report then, because that's clearly where the high-risk part comes from. Give us the key numbers from their snapshot.
Sure. So stock price around $3.52, like we said. That gives it a market cap of about $7.35 billion.
And performance lately?
Not great. Year to date, the report says it's down 19.27%. So it's significantly underperforming the market or its peers.
What about cash? Do they have money in the bank?
They do. The analysis lists a cash position of $3.6 billion. They actually call this a strong liquidity buffer.
$3.6 billion sounds like a lot. But you mentioned a paradox earlier. Is the stock's priced for distress, yet the company's still growing deliveries. What's going on there?
Right, that's the tension. The market seems to be pricing it like failure is almost certain, but the business itself is still moving cars. The report notes Q1 2025 deliveries were 42,094 vehicles.
How does that compare?
That was up 40.1% compared to the same quarter the previous year. So pretty strong growth, actually.
And is that momentum continuing? What about Q2 guidance?
Yeah, the analysis highlights the Q2 2025 guidance. They're expecting between 72,000 and 75,000 deliveries.
Which would be?
That's a 25.5% to 30.7% increase year over year for Q2. So yes, the underlying momentum in getting cars to customers seems to be there, according to the report.
Okay, delivery growth looks positive, but obviously there are those critical concerns about the overall financial health, profitability, cash flow. Let's unpack that side. Any positive financial trends the source mentions?
Yeah, a couple. Q1 2025 revenue hit $1.66 billion, which was up 21.5% year over year.
Okay, revenue growth matching delivery growth roughly.
And importantly, their vehicle margin improved slightly. It went up to 10.2% from 9.2% year over year.
So they're making a tiny bit more profit on each car sold, even with all the price pressure.
Seems like it, yeah. Suggests maybe some efficiency gains.
Selling more cars, getting more revenue, slightly better margins. Sounds okay. So where's the financial distress coming from? This must be the bear case stuff.
Exactly. This is the core risk. The analysis points out that despite that revenue growth, the net loss actually got worse.
How much worse?
It increased 30.2% year over year. The net loss in Q1 2025 was $930 million.
Wow. Almost $1 billion lost in one quarter.
Yep. And that number directly reflects their high cash burn rate. The source specifically calls this out as a major sustainability concern.
Suddenly, that $3.6 billion cash buffer doesn't look quite so strong when you're burning almost $1 billion a quarter.
Precisely. And tied into that, the report mentions the company has negative shareholders' equity.
Negative equity. What does that mean practically?
It was listed at negative $37.4 million as of March 31, 2025. Basically, if you take all the company's assets and subtract all its liabilities and the original shareholder investment, you're left with less than zero. Their debts outweigh their assets minus that initial equity. It's a really clear sign of deep financial strain.
And based on that burn rate, how long does the cash last?
The report estimates their cash runway is only about 4 quarters at the current burn rate.
4 quarters. That is not a lot of breathing room.
No, it's not. And their debt-to-equity ratio is huge, right?
Yeah, the report listed at 345.51%.
So massive leverage, negative equity. It means they're heavily reliant on borrowing and very vulnerable if losses continue or if they need to refinance that debt.
Did they raise money recently? The report mentioned an equity raise.
They did, yeah. In April 2025, they raised HK $4.03 billion, which is about $517 million US.
Okay, so that topped up the cash a bit.
It provided some crucial liquidity, yes. But it came at the cost of dilution for existing shareholders, about 5% dilution, the report estimates.
Meaning each existing share represents a slightly smaller piece of the pie.
Exactly. And the analysis stresses this just underscores how urgently management needs to achieve operational leverage quickly.
Operational leverage. Break that down simply again for us.
Sure. It just means getting to a point where as your sales volume goes up, your profits go up even faster proportionally. You have fixed costs like factories, R&D, building those swap stations.
Which are expensive.
Right. And variable costs like materials for each car. When you sell a lot more cars, those big fixed costs get spread over more units, so each additional car you sell becomes more profitable.
And NIO needs huge volumes to make that work.
That's what the report implies. They need to hit volumes high enough, maybe around the 440,000 or 500,000 annual target they've mentioned, to really get that leverage working and cover all their costs, aiming for break-even by 2026.
Are they trying to cut costs too?
Yes. The analysis mentions cost reduction initiatives. Things like restructuring, integrating processes better, making R&D more efficient, all aimed at getting costs down and helping that path to break even.
Okay, so it's a serious race against time on the financial side. But the report also highlights NIO's strategic strengths, the things that make them different. Let's talk about their 3-brand strategy first. Why do that?
Well, it seems like their answer to the crazy competition in China. Instead of just staying in the high-end premium space.
That's just getting crowded too.
Right, they're expanding to cover different price points. The idea is to grab more market share overall, but still leverage their shared tech, especially that unique battery swapping.
Okay, run us through the brands.
First, you've got the original NIO brand. That's still their premium play, aimed at cars costing over, say, RMB 300,000. The report calls them the leader in premium battery electric vehicles above that price in China.
How are those selling?
In Q1 2025, the report says 27,313 deliveries came from the NIO brand.
Okay. And the newer brands.
Next is ONVO. This is their move into the bigger mass market segment. Price range RMB 200,000 to 300,000.
So competing more directly with...
With the Tesla Model Y, absolutely. Their first model, the L60, is aimed right at it. Positioned as a smart EV for families, ONVO did 14,781 deliveries in Q1, and they just added a new L90 SUV.
Okay, challenging Tesla head-on. What's the third brand?
That's Firefly. This one's brand new, launched April 2025. It targets the compact premium segment, maybe RMB 150,000 to 250,000, smaller EVs.
Interesting. Any plans for that one outside China?
Yes, the analysis mentions Firefly is planned for European launch in Q3 2025. And importantly, it's designed to use simplified, cheaper battery swap stations, like a third of the cost of the main ones.
Okay, that multi-brand strategy makes sense for broader reach. But the analysis really emphasizes one thing as NIO's, quote, ultimate differentiator and most defensible competitive advantage. That's the battery swapping, right?
Oh yeah, that's the core of their unique proposition, according to this report. They built a pretty significant network already.
How big is it now?
The report says 3,354 power swap stations globally. Over 2,200 of those are in China, but they also have 27 in Europe already.
And the main draw is the speed, isn't it? Like super fast.
That's the headline feature.
Yeah.
They claim a swap takes just 144 seconds.
Which is compared to charging.
I mean, compared to maybe 30, 40 minutes or longer at a typical DC fast charger. Assuming you find one that's free and working, it's a massive difference in time. Speed and convenience are huge user benefits.
Are there other advantages the analysis points out beyond just the speed?
Yeah, several. Convenience is when you don't even get out of the car.
Yeah.
Flexibility is another. If you're on their BAOS plan, you could potentially swap in a bigger battery for a road trip, then swap back to a standard one later.
Battery as a service. We'll come back to that. Any others?
Battery health. Since NIO owns and manages the batteries in the network, they can monitor them centrally, maintain them, maybe extend their lifespan. And then there's grid integration. The report mentions the stations have virtual power plant, or VPP, capability.
VPP, what does that mean? Why is that important?
It means the stations aren't just using electricity. They could potentially interact with the grid. They could store energy when it's cheap, maybe overnight, or from solar, and then potentially sell power back to the grid when demand is high or prices are up.
So the swap stations themselves could become revenue generators?
Potentially, yeah, through things like energy arbitrage. The analysis suggests this could make the network more than just a cost center. It could become an asset that actually makes money by helping balance the grid.
That's pretty forward thinking. And they've got a big partner in the battery world involved now.
Yes, a really key development highlighted in the report is the strategic partnership with CATL.
The world's biggest EV battery maker.
Exactly. They formalized this in March 2025. CATL is investing up to RMB 2.5 billion. That's about $346 million US into NIO Power, the subsidiary that runs the swap network.
That sounds like a massive vote of confidence.
It's seen as huge validation for the swapping tech, yeah. Plus, it gives them scale and supply chain advantages.
Okay, so the swapping tech enables this whole battery as a service model, BaaS. How does that work for the customer?
Right, BaaS is critical, especially for the lower-priced ONVO and Firefly brands. The analysis explains that you buy the car without buying the battery pack.
Which makes the car cheaper up front.
Significantly cheaper. By RMB 70,000 to 128,000, according to the report. Instead of buying the battery, you pay a monthly subscription fee.
For the battery and access to the swapping.
Exactly. So it lowers that big initial purchase hurdle. And it creates recurring revenue for NIO. Plus, it directly tackles some big EV adoption barriers for consumers, things like range anxiety, charging time, upfront costs, and worries about the battery degrading over time.
You're essentially renting the most expensive part. And the report mentioned a network effect.
Yeah, the idea is the more swap stations they build, the more convenient the network becomes. That makes BaaS more attractive, encouraging more people to buy NIOs or ONVOs with BaaS, which then justifies building even more stations. It's a classic network effect. The value increases as more people use it.
Makes it hard for competitors to catch up.
Very hard. The report points out high barriers to entry. The capital cost alone is huge, RMB 2-3 million per station, they estimate. Plus the tech complexity, the patents.
And they're still improving the tech.
Yep. The report mentions the latest Power Swap Station 4.0. It uses things like LiDAR and advanced computing to enable fully autonomous swaps. Like the car could potentially drive in and swap its own battery.
Okay, so NIO clearly has these unique strategic weapons, the brands, the swapping tech, the boss model. But like you said, none of this happens in a bubble. The analysis describes the Chinese EV market as, well, brutal.
Yeah, brutal is a good word. The report calls it hyper-competitive, intensely fierce. It's matured incredibly quickly, and now it's basically a survival of the fittest situation.
And the main weapon seems to be price cuts.
Absolutely. A vicious price war. The analysis mentions BYD cutting prices up to 34% recently. And overall, average EV prices in China are down something like 19% in just the last 2 years.
Wow.
Plus, there's oversupply. Too much production capacity chasing demand, leading to high inventories.
And China's EV adoption is already really high, isn't it?
Way ahead in most places. The report says EV penetration is nearing 50% in China. Compare that to, like, under 10% in the U.S.
So it's not a growth market anymore, it's a market share battle.
Exactly. A mature market where companies are fighting tooth and nail for every sale. This leads to serious consolidation risks. The report basically says weaker players might just get wiped out.
Who are the big players NIO is fighting against?
BYD is the elephant in the room. Huge market share, like 32%. Tesla's the main foreign competitor, but the analysis notes they're under pressure, cutting prices, and actually losing share down to around 6% from their peak.
Well, BYD grows.
Right. And then you have other strong local players like Li Auto, XPeng, and a bunch of smaller ones, many with government backing. It's crowded.
So even with premium positioning and unique swapping tech, NIO can't just ignore this market chaos.
No way. The report is clear. That differentiation helps insulate them a bit, but they cannot escape these market dynamics. They absolutely have to prove their value beyond just swapping, especially to justify any price premium. And the success of OMBO and Firefly at lower price points is seen as critical to survive this price war and get the volume they need.
Okay, so stacking it all up.
Yeah.
Unique tech versus a brutal market and shaky finances. How does the analysis weigh the possible outcomes? Let's look at their bull case versus their bear case. What's the argument for the bulls, according to the report?
The core bull case rests on that unique value proposition, mainly the scalable battery swapping. They see it as a real competitive moat that's hard to copy.
Okay. What else needs to happen for the bull case to play out?
It relies on a few potential scenarios. Maybe the price war finally ends through consolidation, leaving fewer, stronger players. Or continued growth in China's premium EV segment where NIO is strong. Success with international expansion, especially Firefly in Europe. And the boss model really proving itself economically, attracting more customers and maybe even partners.
And if they hit those high volumes we talked about?
Yes, that's key. The report emphasizes the potential for massive operational leverage if they get to, say, 500,000 plus cars a year. The fixed costs, including that expensive swap network, get spread so thin that profits could really take off. The swap network itself might even become a profit center through boss fees, energy services, maybe licensing.
Any other bull factors?
The CATL partnership is a big one, seen as validating the tech and possibly leading to more alliances. So if all that aligns, the report gives a bull case stock target range of $7 to $8.50.
Okay, decent upside from $3.50 if things go really well. But the report spends a lot of time on the risks and the bear case. What are the big ones there?
These are the things driving that high H risk label and, frankly, the high chance of failure mentioned in the disclaimer. The most immediate risk is just financial distress.
The cash burn.
Exactly. It's just too high, unsustainable long term. If they can't cut losses fast, they'll need more funding, which likely means more dilution for shareholders. Plus, the high debt and negative equity create refinancing risks and potential working capital problems. Survival is the main issue.
Financial survival is risk number one. What about strategic or operational risks in the bear case?
Also significant. The report mentions execution risks. Like, what if the three brands end up stealing sales from each other instead of growing the total market? Cannibalization.
Right.
There's technology risk too. Swapping is unique now, but what if fast-charging tech gets so good that swapping loses its edge for many people? Regulatory risk is always there in China. Changes in policy, subsidies. And geopolitical risk could hurt their international expansion plans.
The analysis gets really specific about worst-case scenarios, even assigning probabilities. That seems unusual.
It is quite stark. They laid out specific failure possibilities. They put a 15% probability on outright bankruptcy or restructuring within maybe 12, 18 months if the cash burn isn't controlled. Stock goes to zero, basically.
Yeah. Okay.
Then, a higher 25% probability for a forced sale or consolidation. This means they get so weak financially they're forced to sell themselves to a stronger competitor, Likely at a fire sale price, the report estimates maybe $1 to $2 per share in that scenario.
Still a huge loss from here.
Massive. And the most likely negative outcome, according to their analysis, is prolonged distress with a 35% probability. Here, they avoid bankruptcy, but keep needing to raise money dilutively, profitability stays out of reach, and the stock just languishes, probably below $4 for a long time.
So if you add up those probabilities, bankruptcy, forced sale, prolonged distress, the analysis suggests there's, what, a 75% chance of a significantly negative outcome?
Based on their assessment, yes. 15 plus 25 plus 35 equals 75%. It really drives home that significant risk of total loss. Their overall bear case price target range is $1.50 to $1.60, representing a potential 60-75% drop from current levels if the turnaround fails.
Wow. Given those odds, what should investors be watching closely if they were considering the speculation? What are the key risk indicators the report mentions?
They list several red flags to monitor. Quarterly cash burn staying above $800 million consistently, losing significant market share across the brands, missing their own delivery guidance targets, needing another big dilutive equity raise without showing clear progress towards profit, or maybe key executives leaving.
Okay, so after laying out that bleak picture, a 75% chance of bad outcomes, what is StockTelescope.com's final investment recommendation? Did they back away?
No, they actually stick with their initial call. A speculative buy, but only for risk-tolerant investors.
That still feels counterintuitive. With such high odds against it, why recommend even a speculative buy? What's the final rationale in the report?
It all comes back to that asymmetric risk-reward idea. They believe the potential upside scenario, even if it's lower probability, is large enough at the current depressed stock price to justify the gamble for the right kind of investor.
So they're banking on.
They think the technology differentiation, that battery swapping moat, is real and offers a potential lifeline or strategic value. They argue the stock is potentially oversold, meaning the price might already reflect too much bad news, creating opportunity if things stabilize. The $3.6 billion cash position, though dwindling, buys them some time, maybe those 4 quarters, to execute. And they see potential strategic options down the road, maybe partnerships, asset sales, ways to create value short of just bankruptcy.
Okay, so it's a bet that the slim chance of a big payoff is worth the high risk from this specific price point. But there's a massive caveat with that recommendation.
Huge caveat. They state very clearly, because of the market chaos, the cash burn, the execution risks, this is absolutely not suitable as a core holding in anyone's portfolio. It is purely a high-risk speculation, suitable only for a small part of a portfolio that an investor can genuinely afford to lose entirely.
And for someone who does decide to take that speculative plunge, what kind of risk management does the analysis suggest?
Extreme caution. They recommend very careful position sizing, like maybe only 1% to 3% of your total investment portfolio, max. They suggest considering a stop-loss order, maybe below $2.50, as a way to automatically cut losses if the bear case clearly starts playing out.
And time frame, monitoring.
The time horizon for this thesis is 12-24 months, and absolutely critical. Constant monitoring of the company's results and financial health, and having a clear exit strategy beforehand, know when you'd take profits if it goes up, and when you'd cut losses if it goes down.
What are the specific green lights or red flags to watch for, the catalysts and metrics?
Key catalysts to watch would be the Q2 2025 results. Do they show improvement? Clear progress on cost-cutting. Any signs the price war is easing. Milestones hit in international expansion.
And the numbers to track.
Critical metrics are delivery growth across all 3 brands. Improvements in vehicle margins. Are they making more per car? The cash burn rate. Is it shrinking? And market share trends. Strategic milestones include hitting that 440,000 annual delivery target, staying on track for 2026 break-even, the Firefly Europe launch, and continuing to deploy swap stations.
Do they even give specific triggers for getting out?
Yeah, they suggested positive exit triggers might be the stock reaching the upper end of their target, say $6.57, or really strong results showing a clear path to profit emerging. Negative exit triggers would be things like cash burns spiking over $1 billion a quarter, missing delivery guidance badly, major bad news like management changes, or needing another emergency funding round without progress.
Okay, let's wrap this up. To summarize this deep dive into the StockTelescope.com analysis of NIO, we're looking at a company with some potentially game-changing tech, a clear strategic vision.
But facing an absolutely brutal market, burning through cash at an alarming rate, and with a very short timeline to turn things around financially.
Right. The analysis frames it not as a safe investment, but purely as a high-stakes speculation. A bet on whether NIO's unique strengths, especially battery swapping, can possibly overcome what the report sees as a high probability of financial failure or distress.
Exactly. It's a gamble on that asymmetric profile.
And let us repeat one more time. This information is all drawn from the stocktelescope.com analysis. We're presenting it here for informational purposes only to help you understand their view on NIO.
It is definitely not investment advice. Investing in speculative stocks like NIO carries significant risks, including, as the disclaimer stated, the potential for total loss. Always do your own research.
So, for you, our Stock Talk listener, maybe the final thought to mull over is this. In a market this cutthroat, where financial survival is paramount, can truly groundbreaking tech like battery swapping actually build a strong enough moat to ensure NIO not only survives, but eventually thrives?
Or is the sheer financial pressure and the high probability of failure, as outlined in this analysis, just too overwhelming in the end? Something to think about as you do your own homework.
A really critical question. Thanks for tuning in to this deep dive. And please, if you got value from this breakdown,
Hit that subscribe button for the deep dive right now.
subscribe to the deep dive. We appreciate the support.
We'll be back soon with another one.
See you next time.